Hello from the Dukascopy TV studio in Geneva. We're talking about the US 30-year bond rates and the non-farm payroll on the 8th of May with Andrew Gebhardt. He is managing partner from Finex in London. Welcome to the studio, Mr. Gebhardt.
Thank you.
So, who is Finex? Can you outline your product?
Sure. Finex is a UK-based investment manager. We have a variety of funds, but everything that we do is based on technical analysis. We support HPC, which is an OTC, a listed broker based pretty much all over the world now, on their technical analysis and on their platform for technical analysis. So we're here talking about the technical analysis view of the 30-year bond and the impact of the next non-farm payroll on those markets.
Mm-hmm. So we have a little peek into what you're offering. Can you walk us through?
Yes, I mean, this is the live portion of the website where you have the results of various technical analysis methods divided by various products. Everything is listed futures on the usual exchanges, CME, CBOT, and Eurex and Life, now called ICE, sorry, it's not Life anymore. So very simple to view. The methodology itself, the name of the methodology, its positioning with targets and suggested stop levels. In particular, we're going to look at the US 30-year. Why? Non-farm payroll's a very important figure. It's the figure that everyone looks at to give us a direction on what the Fed will do next. The Fed's disappointed a lot of people because it gave us targets to look at for the next rate hike. We achieved those targets, be it employment or growth, and has done nothing about rates. This has been reasonably painful for the market because the market has been positioned short, expecting rates to go up, and in fact they haven't. Last non-farm payroll caused quite a strong reversal, and everyone's looking to the next one, which is the first Thursday of the month, on the 8th. To give us either a final nail in the coffin for the shorts or to give us that beautiful increase of 100 to 200 basis points in the yield curve that many people are expecting. Personally, I find it difficult for the Fed to increase rates at the moment and even this year. There are too many headwinds, be it Asia, be it the fact that the stock market is still so fragile. It's like taking the trainer wheels of a child's bicycle a little bit too early. He might learn to cycle, after a couple of falls, but it's probably not something that you want to do right away.
How do you think people are positioned right now ahead of?
Well, this is the very interesting thing about the US 30-year. It has behaved extremely erratically since the last non-farm payroll. So we had this very strong rally, so a reduction in implied yields. And then you started having these very, very strong sell orders come in. And these orders have been executed extremely poorly. Now, there's two reasons to do that. One, you're short and you want to force the market down. And to do that, you have to do that publicly. And to do that, you also have to do it in substantial size. The other one is you're stopping yourself out. The market hasn't moved high enough for the very large CTAs to have to stop themselves out. It's not necessary. Consequently, it's my opinion, and I think the charts tell us this, that people who are already short are trying to force this market lower. And to be honest, up until last week, they were losing. And I think the longs are finally capitulated. They want to see the minutes this evening. And if you look throughout the chart behind us, you will see these points of very sharp correction. And the fact that the market recovers very quickly afterwards. Remember, this is US 30-year bond, yes? So it is a reasonably volatile market, but it's not the DAX. It's very far away from being the DAX. This is not usual. This is very far from being usual. Look at what happened to many S&Ps yesterday, about 3 o'clock in the London time. About 40,000 lots of S&Ps were sold in one go. Why would you do that? There's no need. There's a liquid market. Any execution desk would have done a better job. So one reason is a stop, and a stop executed extremely poorly. Or two, you're trying to give a message to the market. You're trying to force the market lower. It didn't work. Nor has it worked in the 30 years. So we believe that the big fight here, it's like an old-style Napoleonic war. You have everyone in a line on one side, everyone on the line on the other side. And in fact, your screens almost make a perfect little line there. And you can see just on the bottom right-hand side where the battle line is moving away from the longs. They're losing at the moment. They're losing at the moment, but it takes nothing for the market to move above the 164s and then see much, much lower yields. And we'll see lower yields not because the activity in the US lowers. We will see lower yields only because there is so much money invested in higher yields that if we don't get those higher yields, well, people are going to have to exit. Which is a large cost in holding a position if you're a fund. After all, your investors are paying you a management fee. So there's an erosion cost. It's like holding a long option. It's all very nice, but every day you're paying to hold that. Similarly for a position, if the market doesn't move, you're allocating risk to your position and you're paying for that. And that's not a good thing.
So what would be your suggestion in the run-up to the 8th of May, the non-farm payroll?
Well, very short term, I think that there's no point fighting it. This morning you could have taken a nice little short position, probably looking for about 2 or 3 points to the downside. Ultimately, I think you need to be long into non-farm payroll. I think you have to have the contrarian view. I think that's where it's going to pay. You need to have it in sufficiently small size that you can run a large stop, because the number is going to be extremely volatile. Expect even if the market goes up, the market might go down in the instant that non-farm payroll comes out by even a whole point. So, low volumes, large stops, very large targets is my recommendation.
Mr. Andrew Gebhardt, thank you very much for being here today and sharing your expertise with us. And thanks for watching. Do make sure to keep clicking back on the Dukascopy TV website for latest updates and exclusive interviews. Have a great day and see you next time.